Howdy, y'all. I'm Raymond Dahlman, president of DSA Financial Group, and welcome to the weekly economic update for October 11, 2021. Hope everyone had a fantastic weekend. Pretty good here in Colorado, especially if you're a baseball fan. Astros are up 2-1 on the hated White Sox. And yesterday's game was a stinker, but we got two more. Unfortunately, today's game was postponed due to weather up there. So it looks like we'll be playing tomorrow afternoon. So plan your schedule accordingly. So otherwise, got some chores done around here. Hope everyone got some stuff done over the weekend, or at least got some relaxation in. That's always important. So let's go ahead and jump into the weekly update. So, all righty. The week on Wall Street, the overhang of bumping against the federal debt ceiling was lifted last week with an agreement to extend the debt ceiling through early December, helping propel stocks to a weekly gain. The Dow Jones increased by 1.22%. The S&P 500 added 0.79. The NASDAQ gained 0.09. And the Internationals was flat at plus 0.11. Debt ceiling concerns evaporate for now after suffering losses on concerns over delays with raising the federal debt ceiling. Stocks rebounded as the Senate moved towards finalizing a debt ceiling agreement. While the agreement is only a short-term solution, it was enough to embolden investors to buy stocks. The week's rally ran out of gas on Friday, however, on a surprisingly weak employment report. Though the debt ceiling was the dominant concern in the markets last week, the market grappled all week with headwinds of higher energy prices, rising bond yields, inflation, and a less robust economic growth. All right. Fuzzy unemployment picture. Unemployment remains a confusing and unpredictable element of this post-pandemic economic recovery. ADP employment report showed private sector jobs rose by a robust 568,000. The hiring surge may have been aided by the end of extended unemployment benefits and the return of children to school. The improving labor market was reinforced the following day as weekly initial jobless claims fell below their 4-week moving average, while continuing jobless claims fell by nearly 100,000. The employment report on Friday was a different story. The economy added a disappointing 194,000 jobs, making September the slowest month for job growth this year. Unemployment rate declined to 4.8%, while an increase in wages generated inflation worries. All right. Economic data coming out this week. We have the job opening and labor turnover survey on Tuesday. That's tomorrow. Wednesday, the consumer price index and the FOMC minutes come out on Wednesday. Thursday, jobless claims. Friday, retail sales and consumer sentiment. There's a bunch of companies reporting earnings this week. We have JP Morgan on Wednesday, along with Goldman Sachs, Delta Airlines, and BlackRock. Thursday, we have Wells Fargo, United Health, Citigroup, Walgreens, and Morgan Stanley. Friday, we have JB Hunt Transportation and PNC Financial Services. So that's everything there. As far as, something jumped out at me here. It'll probably come back to me. So, all right, let's go on to the monthly monthly economic updates coming out also to subscribers of my newsletters. U.S. markets for September. The stock market hit a pocket of turbulence in September, with investors turning cautious amid Delta variant infections, slowing economic growth, and ongoing policy debate in Washington. The Dow Jones for the month was up 4.29%. The S&P The Dow Jones fell 4.29%, while the S&P index lost 4.67%, and the NASDAQ dropped 5.31%. So September was not the best month for equities. Sour sentiment. Investor sentiment deteriorated throughout the month. Weighing on stocks was uncertainty about the Federal Reserve's tapering plans, the fiscal and tax policy proposals being debated in Washington, and the economic growth implications of continuing supply bottlenecks. China's influence. The unease culminated in the market's reaction to news that a large, heavily indebted property development company in China was in danger of not making its scheduled interest payments, a prospect that could lead to the company's bankruptcy. The angst dissipated quickly as investors realized that the company's difficulties appeared limited. I don't know about that. from the articles I've been reading, it's quite a serious thing. And my favorite economist, John Malden, did an article had an article on Saturday about it. And I mean, not that it's the worst situation. I don't know if we can compare it to what happened in 2008, but I would be prepared for some ripples through the economy. Fed's update. With that, the market turned its focus to the Federal Reserve's FOMC meeting to learn what the Fed's plans would be with tapering in interest rates. Fed Chair Jerome Powell said that tapering would not begin immediately, but could start by November of 2021. That's next month. The markets also learned that the day is drawing closer to when interest rates may be increased. The support among Fed officials for a rate hike has increased, with half of the 18 Fed members expecting that interest rates will be higher by the close of next year versus just 7 who thought so in June. Higher yields. Just as the market appeared to settle down, volatility picked up again as the 10-year Treasury yield climbed in the final trading days of the month. Technology and other high-growth stocks felt the bump in yields, which added to losses as the month closed. All right. Sector scorecard. The only two sectors to manage gains in September were energy, up 7.26%, and consumer discretionary, up 0.36%. The remaining sectors were down, including communication services, down 5%, consumer staples, down 2.34%, financials, down 2.23%, healthcare, down 4.27%, industrials, down 4.79%, materials, down 6.5%, real estate, down 3.54%, technology, down 4.81%, and utilities, down 6.03%. So, what are investors going to be talking about in October? Over the next several weeks, expect more talk about Jerome Powell, whose 4-year term as Fed chair ends in February of 2022. A survey earlier this year indicated Wall Street overwhelmingly believed Powell would be renominated for a second term by President Biden, with even a greater share of respondents expressing the view that he deserved a second term. Biden is expected to act soon, knowing that any nomination needs to undergo a Senate confirmation process. But Powell's prospects for being renominated appear to be less certain today. During an appearance by Powell before the Senate Banking Committee in September, a prominent committee member stated that she would not support Powell's nomination. Other senators have voiced criticisms of Powell, though they have not publicly declared their opposition. Biden is not obligated to nominate Powell for now. Powell continues to enjoy bipartisan support in the Senate for a second term, but if the resistance to his nomination increases and throws a second term in doubt, it could have an unsettling impact on markets. All right, world markets. The MSCI index slipped 3.18% in September, fighting the headwinds of a tightening monetary policy in Europe, multiple economic challenges in China, and political uncertainty in Germany and Japan. European stocks were mostly lower, with losses in Germany 3.62%, France down 2.4%, and the UK down 0.47%. Pacific Rim markets performance was mixed, with China's Hang Seng down 5.04% and the Australian ASX off 2.69%. Japan bucked the trend and picked up 4.85% last month. All right. Well, I am going to skip over, since we're already 9 minutes in, the quarterly update, just to recap of the third quarter. It is attached in the notes, so feel free to enjoy that. Will the IPO market heat up? The first white paper going out this week. Let me go ahead and start here. If the stock market outlook brightens, there are expectations of a bumper crop of initial public offerings to make their debuts over the next several weeks. Somewhere between 90 and 110 IPOs are preparing to come public by the end of the year, which would make 2021 the biggest year for total capital raise since 2000. But a sluggish stock market may disrupt the best laid plans. The S&P 500 index lost nearly 5% in September, snapping its 7-month winning streak. Companies attempt to make a splash with their IPO, and in the past, some have opted to postpone their public listing if they believe it will meet a lukewarm reception from investors. All right. So we'll keep our eyes out for that. Ready for Medicare open enrollment. Medicare's annual open enrollment period begins on October 15th and ends December 7th. During this time, current Medicare beneficiaries have the option to adjust their coverage for the coming year. Any changes to your plan will go into effect on January 1 of 2022. This is an opportunity to reassess your current coverage and identify potential areas for improvement. Maybe you've recently changed medications, find yourself underutilizing coverage, or in need of additional benefits. Before open enrollment begins, you'll receive a report outlining your current coverage. Review your elections carefully, especially if you haven't updated coverage in the past few years. Medicare offers a plan finder tool to help you compare other offerings if you're considering making a switch. All right. And the last one is just a white paper about what we just talked about. Will Fed Chair Powell get a second term? Again, this really depends upon, what the market does over the next few months. I don't see why they would not renew him or renominate him for a second term. He's done everything that, the administrations, both Trump and Biden have wanted. So, not that I'm in favor of any more government handouts, in the form of paychecks, but, I think the Fed, they probably get paid from the Federal Reserve. So I don't know if it necessarily comes out of our pockets, but anyways, he'll probably get, with all the turmoil and crap going on in the markets and just in the economy, if I were to put a bet on it, I'd say probably 60 to 70% that he'll have the job next March. So, but we will see. All right. I had two articles I did want to share with you. This first one centers around the Pandora Papers. That scandal hit the news wires last week. So we'll go ahead and read through a little bit of this. And I had one more and we'll be done. All right. Saving for a very rainy day. This is written by Eric Margolis. The really wealthy, vexed by tax collectors, pesky relatives, ex-wives, and just plain thieves long ago learned the wisdom of hiding their money and property. This is twice true for politicians. An investigation by an international consortium of journalists just examined a massive leak of 11.9 million records of offshore financial firms that have been evading taxes and financial disclosures for many clients. The result of what is known as the Pandora Papers has been a cascade of scandals. This column has long maintained that the U.S. has been deeply involved in massive international corruption. Chief tawdry examples of the largest recipients of U.S. aid are Israel, Afghanistan, and Jordan. Washington spends over $2 trillion on the now lost. Washington spent over $2 trillion on the now lost 20-year Afghan conflict. All that money has vanished. Among the largest recipients of the Afghan Communist Party and the drug mafias that made U.S.-run Afghanistan the world's largest producer of illegal heroin and morphine. I don't know who's going to fly that stuff out without our helicopters there, so maybe they can fly them. The third recipient of U.S. largesse, Jordan, has gotten $22 billion from the U.S. since the 1950s. Last year, it received $1 billion alone from Washington, mostly to support the Trump administration's crude attempts to buy, threaten, and cajole Arab dictators into a security pact with Israel that seriously screws the Palestinians. In addition, the U.S. has also given $1.7 billion to Jordan to care for a large number of Syrian refugees it shelters, but they were a result of a war started by the U.S. to overthrow Syria's Assad regime, one of the last independent Arab nations. In addition, Jordan's royal family received tens of millions in secret funding from Kuwait, the United Arab Emirates, and reportedly from Israel. Jordan and Oman have long been known for favorite dependencies of Britain's MI6 intelligence services and the CIA. All this money for a small, barren nation of only 10 million is remarkable. Yet one must understand this is a key piece of the U.S. Mideast Empire's architecture. Interestingly, 60% of Jordan's population is believed to be made up of Palestinian refugees from the creation of Israel in May of 1948. Today, 20% of Israel's population is Palestinian. Britain and then the U.S. kept Jordan's ruling Hashemite, I probably said that wrong, dynasty in power. It turned out to be one of the region's most civilized and efficient rulers, though it often relied on the U.S. trained secret police to crush unrest. My mother interviewed the late King Hussein in the 1950s, and at that time discovered that 1 million Palestinian refugees were subsisting in tents. Many still do today. Jordan, a very poor nation that lives on the edge. Jordan is a very poor nation that lives on the edge. So why was King Abdullah II secretly buying more than 100 billion of prime property in Malibu, London, and the French Riviera? Although a web of complex companies designed to disguise all through a web of complex companies designed to disguise the ownership. Powell spokesman claim it was only to assure securities. Saudi and other Gulf royalty make the same claim for their important holdings in Spain and France. So does Spain's recently deposed monarch, King Juan Carlos. Many of the Mideast monarchs and dictators receive secret U.S. cash and property. This has been a fact since the days of Egypt's Anwar Sadat, who was on the CIA's payroll since 1952. France is in charge of payoffs in North African and Black African leaders. It is hard to find an African leader who does not own luxury buildings on the French Riviera or a chic alpine ski resort. Why not? These strongmen risk being overthrown daily. Make hay while the sun shines. Interestingly, some of the world's most vilified leaders, interestingly, some of the third world leaders most vilified by the West have been relatively honest rulers. Good examples are Gamal Abdel Nasser of Egypt, Khomeini, and Ahmadinejad in Iran, and Arafat of Palestine. But it was the crooks and the kleptos like Iran's late Shah and Afghanistan's Ashraf Ghani who got all the press in the West. So kind of interesting. We'll see what happens with all this hidden money for all these world leaders. So I'm sure there's a few of our political leaders who are involved in this. So it'll be funny to see what happens. All right. And then the last one I have, Washington Idiots at Work by David Stockman. This has to do with what the Fed's been doing. So I'll go ahead and just read a couple of things and we'll be out of here. If you don't think Washington's populated by the world's greatest collection of idiots, just consider some of today's incoming data. Starting with another disastrous trade report. The trade deficit in goods for August posted a negative 89.4 billion, which is nearly the worst monthly figure on record and 40% below the already huge negative 63.7 billion deficit posted for the pre-COVID peak in February of 2020. And no, we're not harping here on the trade accounts tsunami of red ink out of some Trumpian affection for protectionism. To the contrary, this is the result of stupid economics, specifically the 6 trillion bacchanalia of COVID bailouts and stimmies enacted during the last 18 months. Self-evidently, the overwhelming share of that gratuitous add-on to spending flowed into the veins of international trade and came ricocheting back in the form of 26 billion monthly increase in goods deficit. Xi Jinping is surely marveling at Washington's endless capacity to keep his Ponzi alive every time it begins to unravel. And this was the case in spring of 2020. Indeed, the blue line is surely marveling at. Indeed, the blue line in the chart has been driven for the last 30 years by massive deficits in goods with China. The latter, in turn, provided the hard currency earnings which enabled the red Shurizens of Beijing to build massive industrial economy from whole cloth on the back of 50 trillion of debt. In the ordinary course, of course, the red Ponzi would have collapsed under the weight of egregious central bank money printing and unserviceable debt build up years ago. But Washington is so smitten by the false economics of the printing press dollar that it permitted its own rogue central bank to race the People's Bank of China to the currency bottom, thereby enabling China's flood of yuan to stay afloat on an even greater inundation of dollars. So if you can see here this chart from the Federal Reserve, and you can see how, from, that's probably about 1990. We've gone from less than a $10 billion deficit, probably closer to five, all the way, we're pushing, or we're over 90 billion now. And, we could be tickling 100 billion very, very soon. So that's about everything I'm going to cover on that. So it's there's quite a lot of words here. So, but I would go ahead and read that. So let me go ahead and get back to the main screen. So hope everyone, like I said, got something from this. If you have any questions, comments, or concerns, feel free to give me a call, shoot me an email. Be sure to like, subscribe, and share this with friends and family. I would certainly appreciate it. And like I said, if anybody needs anything from me, I have no plans to really go anywhere this week, no doctors or anything like that. So I'll be home here at my desk watching the markets. I will be disposed during the Astros game tomorrow. So if you call between those hours, you'll probably get my voicemail. But I'll call you right back. And if it's an emergency, just say, hey, I have a fire. I need you to call me back right now. I'll get back to you immediately. So, all right. Well, I hope everyone has a fantastic week. And like I said, if anybody needs anything, just give me a ring. So have a good day. Bye-bye.